there is very strong consensus for bringing Finland and Sweden into the alliance if they choose to formally apply.
In every past recession, we've grown stronger and faster because people don't stop flying in a recession. They get more price sensitive.
It's definitely a risk. If I were running a big company, I would be very prepared for it. If I was a consumer, I'd be prepared for it, but it's not baked in the cake.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Lockdown havoc, Chinese industrial output and consumer spending sink to the worst levels since the pandemic began. Stock futures and oil weaken. Oil embargo. Germany will stop importing Russian crude by year-end. Even without an EU-wide ban, NATO prepares to welcome Finland and Sweden. Plus, brace for pain. Goldman's actually cut its U.S. growth forecast. The senior chairman, Lloyd Blankfein, warns there's a very, very high risk of a recession. Now, first thing is first, let's check on the markets because they tell a picture of 1,000 words. This is a picture for the European stock 600. They're actually down some 0.3%. We did start the session, if I could get my words out. Happy Monday, everyone. We hope you had a great weekend. If you look at European stock 600, they were down some 0.8% at the open. So some of the anxiousness that we saw because of that, of course, China data seems to be abating somewhat. Technology still on the down, 0.9% lower. It's really this poor Chinese economic data that fuels concern about the global outlook, pouring cold water on last week's brief revival of risk sentiment. The dollar, watch out for dollar, but I would suggest watch out for, of course, the dollar against euro, the dollar against sterling. Currently, we have the Bloomberg U.S. dollar index at 1258. And then Bitcoin, always good to talk about Bitcoin. Is it the new hedge against inflation? What is it exactly? We pay attention when it's below 30,000, currently at 29.615 after a bout of a huge, strong volatility that we saw over last week. Now, this is a picture for European stocks. Certainly, if we have the map where we look at what countries are holding up and the ones that are doing worse. So you have the UK. This is very commodity rich. If you look at oil, it's seeing a little bit of pressure, but still holding on pretty much steady, even on the back of that Chinese data. So the FTSE down 0.1%. The FTSE MIB also down 0.1%. But then if you look at the DAX and the CAC 40 down 0.5%. The IBEX over in Spain, look at that. It's pretty much flat. Now, Goldman Sachs senior chairman Lloyd Blankfein has urged companies and consumers to prepare for a U.S. recession. In an interview with CBS, he says it's not a certainty, but there's only a narrow path to avoid it.
Do you think we're headed towards recession?
We're certainly heading. It's certainly a very, very high risk factor, and there's a path. It's a narrow path, but I think the Fed has very powerful tools. It's hard to finely tune them, and it's hard to see the effects of them quickly enough to alter it, but. I think they are. I think they're responding well. I think it's definitely a risk. If I were running a big company, I would be very prepared for it. If I was a consumer, I'd be prepared for it. But it's not baked in the cake.
Now we're joined by Banu Baweja. He's chief strategist at UBS Investment Bank. Banu, as always, thank you so much for joining us. Recession or recession? What kind of correction can we see?
Look, it's late cycle. It's not about growth. I don't think it hasn't been for a while. I think it's about liquidity, right? And real interest rates are rising and credit spreads are going to widen. So I think you can see a further correction. So you could, in the worst case, if you do get a recession, plus you get real rates going higher, get towards about 3,600 on the S&P. But I don't think it's only about growth. I think at this minute, the numbers are actually going to start getting better in Q2, Q3.
Across the world or only in the U.S.?
In the U.S. In China, Q2 is going to be diabolical. You're going to get about a 6% annualized correction in China in terms of the economic growth.
So why were we not expecting the ugly China numbers that we had today? If you have a full lockdown, and we were reporting on it, I mean, it was clear to see. Why did we not get it right?
China data has always been extremely volatile. Right? So in terms of whether or not you're seeing the freight data improve, whether or not you're seeing actually the subway traffic improve, these are difficult numbers to put in place. But, you know, also their FAI number, their fixed asset investment number, is always a number that they put in as a residual, which actually lifts the overall numbers. But you see from consumer sentiment, by the way, this is not just China. You've seen this in the US, you've seen this in Europe, you've seen this especially in the UK, which I think is the laboratory of the stagflation thesis, that in fact retail sales have been extremely poor. So the consumer has been on strike in real terms for some time. When I say some time, I mean about 4 quarters now, since Q2 of 2021, the consumer has been quite weak. What's different now, of course, China is completely different because they have shut down. But in other places, CapEx sentiment is weakening. We'll see this week in the US as well. CapEx sentiment is weakening. But the question is this a garden variety slowdown because inflation is up, or is this a proper recession? I don't think it is.
Does this end well?
Well, look, we are late cycle. We are going to get a recession at some point, but it's not imminent at all. I think the liquidity question is the bigger question than the growth question. And liquidity is tightening, and that's the headwind for the markets. We're coming from a very strong place, so I think there's further to go on market correction.
Can central banks do anything with liquidity?
They need to tighten it. They need to tighten it. The liquidity is not collapsing in a sense of financial markets breaking. Yes, there's a little bit of lack of liquidity in the tips market, in the credit market, but they need to tighten liquidity because inflation is the elephant in the room.
But what I don't understand is that basically, a lot of central bankers around the world are also guiding the market. So is it because they're worried? I mean, there's guiding the market at some point, that there's this interdependence about what markets are doing and what the Fed, for example, is telling them, taking out the 75 basis points off the table. So what's the relationship right now?
Well, in terms of where the Fed's put is, there's no doubt that the strike of the Fed's put has moved much further. And I think the market we need to watch more than the equity market is the credit market.
Yeah.
And out there, if you see sort of high yield credit spreads relative to IG credit spreads, they're actually closer to their tights than their wides. So they're actually closer to peak cycle rather than closer to a recession. So not all markets are talking about a recession.
Right.
By the way, the bond market is completely, it disagrees with the recession because at one point it had completely flattened and also had begun to invert. But if you look at further out, 2 to 3 years, markets have taken out cuts.
Yeah.
So you don't take the terminal rate high when you're worried about a recession.
Yeah, but even in the inverted yield curve, it would have been very easy for the Fed not to make that happen. Right? They could have controlled that.
They could have controlled that, but the Fed at this minute has a one-point agenda, sort of an unconstrained optimization. They just have to go hard to slow down inflation. And if that means the demand route, they probably have to do that, right? But you're coming from a very, very high... Look at the banks, okay? The banking system is not under stress. Non-performing loans are not increasing. Default rates are still on the sort of 3 handle. If you look at the labor market, still extremely tight. The consumer's on strike. It has been for 3 to 4 quarters in real terms. And CapEx is slowing down at the margin. But it is likely that as we go towards late Q2, early Q3, some of this data begins to improve. Russia permitting, natural gas permitting. So that, I think, is the big issue.
So
where structurally you have a problem is China, I think.
So where do you see the best investments right now?
So in terms of the whole market as a whole, I think probably comes a little bit lower because I think the growth stocks are going to drag down. But there's some parts of European cyclicals that are already beginning to price in a recession. Sort of a 40% chance of a recession is already being priced in some consumer names and some financial names. And these are the places where you begin to buy. I think break-evens are too high, so break-evens begin to come down. So in the bond market, if we're going to go back into the bond market, rather than going to real rates, which can still lift, I think break-evens come down.
And you would go back to the bond market, this is the right time?
Inflation break-evens, not in real yields right now, yes.
Quickly on Europe, what do you do? I mean, because of the proximity, of course, to Russia, is it going to be very difficult for the ECB to raise rates?
I think the ECB will have to because inflation is high and is broadening. So we're going to get some data this week as well. So 7.5% is what we think, and we think this stays here till September. So I think the ECB will have to raise rates. A bigger question further down the line is whether you're going to manage inflation or you're going to manage spreads. But hopefully that's not a question for now.
Oh, it'll be a question in the next block. Thank you so much, Banu Asia, Chief Strategist at UBS Investment Bank, stays with us. So fun to have you in the studio. Thank you, Banu. Coming up, book your plane tickets. Goldman Sachs will allow its senior staff to take unlimited number of vacation days. I'm not sure whether you can leave the country or not, but look at that. We're showing you beautiful pictures of white sandy beaches where you could go on vacation. We'll talk the latest move by a Wall Street bank to retain talent in a hot job market. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, NATO members have enthusiastically rallied around Finland and Sweden after they announced plans to join the alliance, marking another dramatic change in Europe's security architecture triggered by Russia's war in Ukraine. Their accession will bring improved ability for the alliance to defend the Baltic region. Now, for more, we're joined by Bloomberg's Rome Bureau Chief Alessandro Speciale and our Euro reporter Maria Tadeo. So, Alessandro, what has been the reaction to the applications, and how does this process actually proceed from here?
Well, the reaction has been overwhelmingly positive. NATO members, especially Eastern European NATO members, the Baltic countries, which were once part of the Soviet Union, are very happy that Finland and Sweden will be joining, which means that the northern flank of the NATO alliance will be shored up. There will be 1,000 more kilometers of border with Russia, and in an event of a conflict, the risk of the Baltic countries remaining isolated from the rest of Europe is much, much less. There will be ways to bring them support. Of course, Turkey has voiced some concerns, especially because of Sweden's support of Kurdish terrorists, what Turkey names terrorists. But Stoltenberg, the NATO chief, has said that he is confident that these wrinkles will be eased out.
Thank you, Alessandro. And Maria, the G7 foreign ministers meeting wrapped with a strong commitment to Ukraine's territorial integrity, but still no deal on a Russian energy embargo.
Yes, and this was a G7 meeting, of course, that was led by Annalena Baerbock in what is her first big diplomatic test as foreign minister of Germany. Now, they agreed on that statement that they would never recognize a potential land grab from Russia in the east of Ukraine. Remember, that's where the fight is at. And we've seen that Russia is putting on the table those referendums that they've done in the past to try to annex Ukrainian territory into the Russian Federation. The G7 was clear, we're not going to accept any of this new lines, artificial lines drawn by Russia. However, Francine, you're very right to note that oil embargo, it's been weeks now, and the EU27 is not able to get to an agreement. A lot of this has to do with Hungary and Viktor Orban. The Germans now saying an ultimatum, if we don't agree with this, then we'll just go by ourselves alone, and we'll do this by the end of the year. We're going to pull out of Russian oil, whether or not there's a deal at an EU27 level.
Europe correspondent there, Maria Tadeo, and our Rome bureau chief, also Alessandro Speciale. Thank you both. Don't miss an exclusive conversation also in a few hours from now. Ukrainian Foreign Minister Dmytro Kuleba joins Maria for an exclusive conversation from Brussels. Now we're back with Banu Baweja, chief strategist at UBS Investment Bank. We were talking, Banu, of course, about inflation. I want to talk a bit about the UK and China. But what's the likelihood that we get some kind of energy embargo? If we start touching Russian gas, what happens to Europe?
That's the one way you can get stagflation, right? If Europe says, I don't want Russian crude, there is a possibility that Russia says, you can't also have my natural gas. And that's the channel through which because crude is fungible, more fungible than natural gas is. And if Russia was to shut off the supplies of natural gas, that's the channel through which you get both inflation and much weaker growth. Now, the reality of the ground is actually quite the opposite in that since the war, you've actually seen storage utilization facilities for natural gas fill up. Right? So Europe is getting the gas, and Russia is also sending so far. So far, the disruption, even in crude, let alone natural gas, has only been about 1 million barrels a day. So I think we have to watch and see. But if Europe is to shut off crude, and if Russia says you need to pay for this in rubles only, or if they shut off the natural gas, that's when we will have to change our mind on bonds, on equities, everything. That is a game changer.
But we're also just getting some breaking news out of the U.S. Senate Majority Leader Mitch McConnell speaking in Finland, saying that there's strong bipartisan support for Finland joining NATO, and he says he aims to approve Finland in NATO before the August recess. Does this change anything to the way you view the economics? It's hard to look at, well, first of all, to be in Vladimir Putin's mind, really, to try and figure out what, economic ramifications this horrible war means.
Well, it probably means that the long-term price of oil, so 12 months out or even 60 months out, 5 years out, is probably going to stay elevated right now. So that risk premium is not going to go down. The curve has been extremely backwardated, but long-term oil and long-term energy prices can go up, which is important for central banks because, when you pose the question you posed to me earlier about ECB, what does the ECB do? To someone who's as centrist as Schnabel at the ECB, they have been saying that, look, earlier we'll look through this. We can't look through this anymore because this is impacting inflation expectations. So if this tension in natural gas, in crude, keeps long-term inflation expectations higher, central banks will have to react, and that takes away liquidity from the market.
But what do you do with the UK? So the UK is kind of almost a template of everything that we're living through, but just much more intensely. It's inflation, it's a central bank that is not quite sure what...
UK has some idiosyncratic negatives, right, Francine, because it has Brexit. The labour market is super tight, but not because not only because demand is strong, unlike the US, it is also because supply curve has moved left because of Brexit, right? So the participation rate is worse than it is in the US. It hasn't recovered, despite the fact that you didn't get the same amount of stimulus. So this, I'm afraid, is almost the laboratory of the stagflation thesis. If stagflation is going to come, it probably is going to come here. It's probably going to come here before. And this is why I think the one central bank who is umming and ahhing a little bit more than the others in terms of inflation, correctly so, is the Bank of England.
Why correctly? Because they seem to also be behind the curve.
They are behind the curve, but they ought to be much more worried about growth than other central banks. Because again, if inflation is high because the supply curve has moved left, and that solves for a lesser equilibrium output, and that basically means that you have to be worried about growth as well. So labor market tights right now, but we have to watch for what happens in financial conditions, watch for what happens in housing, for instance, and go from there. So I think they have to step on broken glass very gently.
I mean, the Northern Ireland Protocol is also another thing that we are looking at. What would it mean if there was a unilateral pulling out?
Well, the possibility of a hard Brexit then really becomes sort of embedded, and that puts pressure on the sterling, that puts pressure, therefore, on inflation, and creates more room for the BOE have to be hawkish in a tight economy or in an economy that's at that point weakening. So I think, of course, that creates much more trouble for assets in Europe, and that's why local assets, so if you look at the FTSE 250 relative to the FTSE 350, that has been suffering, and I think we can see a bit more of that.
I need to correct myself, because Mitch McConnell, of course, is a minority, U.S. Senate minority leader. This is what happens to a brain after we've had a good weekend on a Monday morning. Banu, talk to me about China. So what are the longer-term implications of this China that's grappling with this zero-COVID policy? I mean, does it stick with it?
It probably sticks with it, Francine, but I think, even before the zero-COVID policy, common prosperity had, I think, been a big change in the markets. In my opinion, in 10 years' time, when you look back at 2021, 2022, you're probably not going to think about inflation exploding. You're probably going to remember that China changed its reaction function for the first time in 42 years. That could be sort of the biggest change in the global economy on a 5 to 10 year horizon, and I think that matters for the rest of the world as well.
So, and the market is not looking at that yet, because they're on the much shorter horizon?
That's a disinflationary impact in the medium term. So commodity prices are not there, right? Copper, iron ore has been okay. Copper prices have been flying. So this impact, I think, is a temporary impact on these markets being lifted because of electrification and so on. Chinese real estate, I think, is the bigger driver of these markets in the medium term. So personally, I would not be chasing materials much higher here.
Because also you see, I mean, for example, the U.S. is sitting on quite a lot of rare earths.
That's absolutely right.
Does the Russia situation mean that a lot of countries that can afford it will start digging these, even if it's a higher cost?
Yes, that's very possible that'll go. But at the same time, we have to think about more fundamental issues like what is the demand for oil in the medium term from China? What is the demand for copper from China and iron ore? I think this is what's going to drive commodity prices in the broader complex. And I think that demand is going to come down because unlike the US, where investment to GDP is actually likely to pick up in the next several years, in China, it's going to very clearly come down. And that's not priced in the markets. Only the rate markets. Look at Aussie back end relative to the US back end. Doesn't make a lot of sense.
Banu, thank you so much. I could speak to you for another 3 hours, so don't be a stranger, Banu. Come back soon, right here on Bloomberg Surveillance, early edition. Banu Baweja, Chief Strategist at UBS Investment Bank. Coming up, the European Bank for Reconstruction and Development commits another 1 billion euros in aid to Ukraine. We'll be joined by the EBRD's president, Odile Renaud-Bassot, to discuss how the bank is reacting to the fallout of the war. That's in around 20 minutes from now. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's take a look at some of the things to watch out for this week. Today, the European Commission releases its spring economic forecast. Now, today is also the deadline for hedge funds to disclose their U.S. equity investments for the first quarter in 13F filings with the SEC. On Tuesday, Fed Chair Jay Powell speaks at the Wall Street Journal's Future of Everything conference. We'll also have U.S. retail sales data along with Walmart earnings. Then on Wednesday, Tencent reports their first quarter results. Also, G7 finance ministers and central bankers meet for a summit in Bonn, Germany. On Thursday, the ECB publishes the minutes from its April policy meeting. We'll also have U.S. initial jobless claims. And then Friday, President Joe Biden begins a 4-day trip to South Korea and Japan. Plus, the latest CPI from Japan is also released. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne, and happy Monday.
Happy Monday to you, Francine, and hello. It's been a while since we've been on set together. How nice. Now, Germany says it will stop importing Russian oil by the end of the year, even if there's not an agreement on an EU-wide ban. Foreign ministers from the bloc are meeting today to discuss the next round of sanctions. This comes after EU diplomats discussed a delay in the oil ban after objections came from Hungary. Now, China's economy is paying the price for its COVID-0 policy, with industrial output and consumer spending sliding to the worst level seen since the pandemic did begin. Retail sales contracted 11.1% in April from a year ago, far weaker than the 6.6% drop forecast by economists. Industrial output unexpectedly fell 2.9% in the period. Now, Boris Johnson is warning the UK will press ahead with unilateral changes to parts of the Brexit agreement if the EU does not engage in genuine dialogue. This comes ahead of a visit by the Prime Minister to Northern Ireland. Now, that's happening today. London is unhappy at checks on UK goods crossing the Irish Sea, as mandated by the Northern Ireland Protocol. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. More markets. This is Bloomberg. Lockdown havoc, Chinese industrial output and consumer spending sink to the worst level since the pandemic began. Oil embargo, Germany will stop importing Russian crude by year-end. Even without an EU-wide ban, NATO prepares to welcome Finland and Sweden. Plus, brace for pain, Goldman cuts its U.S. growth forecast as senior chairman Lloyd Blankfein warns they're very, very high risk of a recession. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Ryanair issued a guardedly optimistic outlook for the vital summer season, cautioning that a strong bookings trend could still be disrupted by a number of factors, including Russia's invasion of Ukraine. We've been speaking to the chief executive, Michael O'Leary.
We're so big across so many markets in Europe. Certainly, there's very strong demand to the beaches, the leisure destinations of Europe this summer. But we also have a huge business in, UK short-haul domestic travel, Italy domestic travel, Spain domestic travel, and that books much later because it's domestic travel. And it's prone to being very badly disrupted by adverse news flows. We saw it with Omicron at Christmas. We saw it with the Ukraine invasion at Easter. So I think we're sensible this morning to be cautious. We've seen too many airlines out there in recent weeks, talking up the recovery, mainly because their balance sheets are shot to pieces. But they're talking up the recovery. The end of Omicron is here. We can't eliminate the risk of another variant next winter. You see what's going on in China at the moment. They're struggling to contain COVID generally. So I think we're seeing very strong recovery into the summer, but I'd be very cautious on next winter for the moment. We have a very strong balance sheet. We raised cash both from shareholders and in the bond market during COVID. As we've just said this morning, we finished the year at the end of March with 3.3 billion in cash. That figure has since risen to over 4 billion thanks to the strong forward bookings into the summer. So we have a very strong balance sheet, no requirement for additional equity.
Well, that was Ryanair Chief Executive Officer Michael O'Leary. Now, a sell-off in crypto accelerated today after weak data from the Chinese economy actually dented appetite for riskier assets. But in comparison to last week's turmoil, the crypto markets are calmer. Well, we're now joined by Marion Laboure, analyst at Deutsche Bank Research. Marion, thank you so much for joining us. It's been wild for the last couple of weeks of crypto. What are you seeing out there?
Yeah, thank you very much for welcoming me here. So I would say that cryptocurrencies are currently facing a spring cleaning, and it's very important to put things in perspective. If we look back in 2017, the market cap of cryptocurrencies in general was $18 billion, and the value of one Bitcoin that year was 1,000. In 2021, at the peak, the market cap of all cryptocurrencies was $2.9 trillion, and the value of one Bitcoin was $68,000 in November. So today, as a demonstration of this extremely volatile market, the market cap for all crypto is around 1.2 trillion, and the value of one Bitcoin, I would say, is around 30,000. So as we can see, there is a wild fluctuation in value, and it raises the question, what's the real value of cryptocurrencies? And as I mentioned a few times, this is a highly volatile market. We expect to remain volatile in the short term. And having said that, we should also notice that crypto integration within broader financial markets is still small, but the Bitcoin market is also equivalent to be the 8th largest company in the world by market cap.
So Marion, so talk to me a little bit about what cryptocurrencies are right now. Is it a hedge against inflation? They seem to be very correlated, of course, with what's happening with tech and US equity stocks.
Yeah, so that's a very good one. So the correlation between crypto price and the Nasdaq remains extremely high, as you mentioned. And we have seen that in the equity market already, and it's actually what we are seeing now for cryptocurrencies in general. And similar to equity, I think we are facing an uncertain economic outlook, high inflation, rate high expectations, even more, and a geopolitical conflict. So on digital gold, as you mentioned, is it like a good hedge against inflation? I think it was the case. It's no longer the case. Cryptocurrency did see price increase as inflation peaked last year, but this was due to excess liquidity that also drove tech stocks much higher. So given that the Fed turned hawkish, we expect higher rates. I don't think it is at the moment. And as we saw it in May, a few days ago, inflation peaked at 8%.
So, Marion, what kind of volatility are you still expecting? I know it's a very difficult question, but I don't know if you're looking at levels or just expecting it to zigzag quite a lot until we get regulation. Is regulation a good or a bad thing for this crypto space?
So I think we need regulation, and there is a real push for regulation, as we have seen last week, especially for stable coins. And in terms of volatility, I expect cryptocurrencies to remain volatile, and regulation, I see it as a good thing. First, the crypto market needs to be regulated. It needs to have like a clear framework for companies, for consumers, for everyone in the market. And I expect regulation, when we will have a clear framework, to have probably more companies to start buying in crypto. So crypto as a mean of payment, and to have a volatility which is lower, driven by a higher liquidity.
Marion, where do you see the biggest, I don't know whether it's, there's psychological factors of this buy and sell mentality, or whether it's based on fundamentals, and how you see that developing in tandem with regulations?
Yeah, so I think that there is many different factors. Actually, we explained the drop last week. Obviously there are the news due to stable coin that we have seen. In terms of psychology, I also think that it plays a role, and I would say that the Tinkerbell effect is there even more these days, and people tend to think actually and tend to pay the price that they are thinking, that they perceive in terms of cryptocurrency. So there is a lot of the Tinkerbell effect, and we are also seeing that crypto, and it's true for crypto in general, but even more for Bitcoin. It tends to be like closer and much more regulated to US equities and to the Nasdaq in particular. So when you have like an uncertain outlook, high inflation, high expectations, geopolitical conflict, it pays even more the price.
Marion, what is the real value of cryptocurrencies? Like, what kind of fundamentals do you look at to find that?
Yeah, so as I said, you have like several fundamentals. In terms of rational factors, you can look at the supply, the demand. Regulation is going to play a big role looking forward, depending on what we get in terms of clear framework. And volatility is still going to be there as well, and the geopolitical context will be like increasingly dominant in thinking about like rate hikes, especially on the Fed.
Marion, thank you so much for joining us. Marion Laboure, they're analyst at Deutsche Bank Research, joining us on crypto. We're so happy we found a crypto analyst, Marion, so congratulations on that. Makes our life so much easier. Coming up, the European Bank for Reconstruction and Development commits another €1 million in aid to Ukraine. We'll be joined by President Odile Renaud-Bassot to discuss how the bank is reacting to the fallout of the war. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine, and thank you. Ryanair has issued a cautiously optimistic outlook for the vital summer season. Europe's largest discount airline said that a strong bookings trend could still be disrupted by a number of factors, including the war in Ukraine. Ryanair says it's targeting what it calls reasonable profitability this fiscal year. Now, Saudi Aramco has posted its highest profits since its stock market listing. The company saw a boost from surging oil prices in the wake of Russia's invasion of Ukraine. Net income rose to almost $40 billion in the first quarter, up 82% from a year earlier. Last week, Aramco surpassed Apple to become the world's most valuable company. And a Bloomberg scoop has revealed that Credit Suisse's board has held early-stage talks on potentially replacing CEO Thomas Gottstein as soon as this year after a string of scandals and misfires. While the board continues to publicly voice support for Gottstein, some members are said to be increasingly worried that he's not getting a handle on the bank's problems. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, the European Bank for Reconstruction and Development committed another 1 billion euros of aid to Ukraine at its 2022 annual meeting in Marrakesh. The impact of the war dominated discussions, and the EBRD president, Odile Renaud-Bassot, acknowledged that it will shape the bank's activity for years to come. Well, we're now joined by the president, Odile Renaud-Bassot of the EBRD. Thank you so much for joining us, Mrs. President. When you look, first of all, at the annual conference, you announced that donors will commit to this 1 billion euros for Ukraine. What role do you, first of all, expect the EBRD to play in this, and when can Ukraine actually receive the money?
So the role of the EBRD in Ukraine has been historically very important. We've been intervening in the country in the last 30 years, financing 16 billion of investment over the last 30 years of activity there. And what we are doing now, when the country is in war and facing huge economic and financial challenges, is to focus on supporting the real economy. So we finance, for example, trade finance, supporting import and export of goods, but also big public infrastructure to keep the basic services for the population of the business functioning, such as electricity, gas, but also the railways. Railways are very important in the context of the war to transport people, but also to transport food and so forth. And we are also supporting the private sector, for example, for the swing campaign and food security, partnering with local banks and providing them some support. We expect to be able to disburse very quickly, on this project, and so in the coming months, before end of June, we expect to disburse 400 million, and then 1 billion at least in the course of 2032. Sorry.
So what happens once the war is over? And I don't know whether you have a timeline that you're working on. I know, of course, it's extremely unpredictable and difficult to know, but is there more of an effort also after this ends?
So, of course, when the war will be over, but I cannot give you a timeline. I think nobody really knows when this will happen, but there will be huge needs for reconstruction. And it's also possible that we will need to start rebuilding some infrastructure, for example, some bridges that have been destroyed, railways and electricity component already before a full-fledged peace agreement is there. But I think when we will move towards reconstruction, it's very clearly acknowledged that the needs, financial needs will be huge. The level of destruction, for example, of infrastructure is assessed by Ukrainian economists at something like 90 billion euros destroyed already. And so that will be a huge effort, and I think the EBRD will play an important role in that effort.
Of course, Russia and Ukraine are big exporters of agricultural commodities. So how is that impacting the access to food, especially in Northern Africa?
It's a huge question because currently Ukraine has a lot of grain in storage that cannot get out of the country. It was the storage campaign from last year, and usually it's transported by boats from the Black Sea, and now the access is completely stopped. Russia, there is a sort of blocus, and there is no capacity to export the grain. And this is a huge challenge for food security worldwide, because countries like Morocco or Egypt buy a lot of food from Ukraine and Russia. These two countries represent more than 40%, 50% of grain export worldwide. So this creates a huge challenge, and there is a big logistical issue, because transporting grain through trucks or railway it's impossible to have the same capacity level.
So what does it mean longer term? Is there, are there other countries that could, make up for some of that loss in supply, or do you see a population needing to adapt to what they eat?
No, there is a lot of work, I think, at the global level to try to step up production in other countries. And in that respect, I think the recent trend from some countries to limit and to forbid export of grain and so forth is not a good news, because it will create a lot of difficulties in the trading and feeding some of the countries. So I think that's, but a big effort must be put on increasing overall capacity, providing also fertilizers in all countries that are needed, because this is also one challenge created by the war, but also helping to find some solution with Ukraine in the very short term.
Yeah. What are your members actually saying about Russia? I know we heard and we saw tweets about certain members, of course, walking out when the Russian, the Belarusian delegation was talking. Can you give us a flavor of what some of these meetings are like?
So I will not comment on what happened in the meeting, but of course, EBRD has taken a very clear position condemning the war very early. I mean, in the few hours after the invasion. We've also, with a very strong support from our shareholders, decided to suspend formally any access to EBRD resources to Russia and Belarus. So this reflects the feeling of a very large number of our members that are, condemning very, very strongly the war and the attitude by Russia and Belarus.
Do you see a rapprochement possible between the two sides?
I always hope that there can be a peaceful solution and peace talks, but it seems to be extremely difficult. But of course, I hope that a solution can be found.
Odile Renaud-Bassot, thank you so much for joining us today. That was the president of the European Bank for Reconstruction and Development joining us. Now, coming up, Goldman Sachs offers senior staff unlimited vacation. Think about that. Think about where you'd be going and actually whether you'd be able to take the vacation. As odd as it seems, we're going to delve whether people actually take their holidays. We're just speaking to a senior banker saying, well, I have a lot of holidays I haven't been taking anyway. We delve into that next. This is Bloomberg.
I'm taking inflation very seriously, and it's my top domestic priority. There are things we can do. That starts with the Federal Reserve.
I worry that the Federal Reserve has tried to be too nice to markets.
75 basis point in an increase is not something the committee is actively considering.
You cannot come on TV and speak about all the uncertainties and then rule out a certain policy response, 75 basis points.
50 basis points, is already a pretty aggressive move. I don't think we need to be moving even more aggressive.
It is absolutely essential that the Fed regain credibility.
We don't rule out 75 forever.
It will not do so until it does what the ECB did.
Inflation has increased significantly and will remain high over the coming months.
I must commend the Bank of England.
UK GDP growth is expected to slow sharply. Monetary policy, therefore, must navigate a narrow path.
I wish other central bankers were as honest and as balanced as Andrew Bailey was.
Well, that was Bloomberg TV guests and policymakers reacting to the MLive question, which central bank has been the best at communicating policy guidance. Now, Other news we're watching, and it's also to do with the banks, but this is Goldman Sachs saying it will allow its senior staff to take unlimited number of vacation days. It's seen as the latest move by a Wall Street bank to retain talent in a heated job market. For more, we're joined by Bloomberg's finance editor for the UK and Middle East, Tom Metcalf. Tom, you were not expecting, he sat down, Tom, and he said, I was not expecting to talk about unlimited vacation days at Goldman Sachs. First of all, do bankers even take their full holiday?
Yeah,
No.
exactly. And this policy applies to Goldman's partners, Goldman's managing directors. So those are not the type of people you normally expect to, take, even days a quarter.
What I love is that our producers are now showing like pictures of sandy beaches and like exotic places, like remote islands. So is this just like a massive smart PR ploy?
Yeah, I think I certainly do not read this as seeing that you'll see the Goldman bankers at the beach. I think it's sort of, like you say, every bank's wanting to put forward that it's kind of, a mature organisation. Maybe this sort of long-standing culture of, work at the expense of everything else is no longer so sort of prevalent. But I think really the reality when you see some of these policies implemented at firms like Goldman is it's not that staff take too much holiday. It's quite the opposite. Staff take less than they originally had allocated under older policies.
Yeah, and psychologically, we were speaking to someone. Look at that beautiful beach. Tell me you'd rather be in the office.
I would rather be there right now.
At Goldman Sachs than here. I guess psychologically, it gives you more bandwidth, right? So is it better than a pay rise? I know you're not like a mind reader of the traders. But again, I guess if you have to show flexibility, but you want people in the office, you have to find some of these perks.
No, absolutely. And there's lots of evidence from surveys that this is actually something that sort of job applicants and people thinking about which firms to join, it's very, very attractive to them. And it might just be that in reality, they turn up and realise, oh, this is not those Miami beaches, this is not those sort of sun-kissed lounges. It's much more like I'm in the office more than ever because it's sort of that sort of pressure where you don't really want to take too much holiday.
This is great because you go into Goldman Sachs or another one at 20 years old, you see the beaches, you say, I'm going to work hard for 10 years, I'm going to be made, managing partner, and then I go on holiday. But then the reality is once you're at that level, you just can't take it off.
Yeah, it just never stops, right?
It's a genius.
It is.
In terms of bankers' pay, are you still seeing that race to the upside to make sure that they attract the right talent?
So, well, it's slowed down a lot, so that was pretty much the theme of all last year. It'd be interesting to see if any more of those kind of hikes come in. They were mainly for the junior staff. So what's also interesting about this Goldman announcements is for the junior staff, they have up the holiday allowance something, so they don't have unlimited vacation, but they did get a couple of extra days. So I think we will see more moves like this, sort of on the softer side. Whether on the pay side, with markets being like they are, it's hard to know whether the banks will be the winners or have to sort of look to cut compensation.
Where are you going on holiday? Come on, you have a month off.
I will go to the English coast, I think. No travel or anything, just stay in the country.
What? I'm going to the Pacific Ocean, then we trade. So I'm going to Tahiti. That's where I would go if I had a free month off.
That'll
and then you'll be in Devon.
Yeah, exactly.
Yeah, and then we'll exchange pictures, and then the viewers can vote who got it right. Tom, thank you so much. Our Bloomberg's Tom Metcalf. Now, this is what the picture is looking like for the markets. Stocks in Europe wavering, U.S. equity futures also slipping. Traders weighing China's latest measure to support its economy after poor data fueled concerns about the global outlook. Now, Chinese data did show industrial output and consumer spending hit the worst levels since the pandemic began. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz, and Anna Edwards. This is Bloomberg.
You may not lose a lot, but you're certainly absorbing a tremendous amount of volatility for taking risk in the U.S. equity market.
The fears we have today are tied to one thing, really, inflation. That is the elephant in the room.
I hope we can stabilize around these levels, but I certainly wouldn't count on us getting back to all-time highs.
The Fed has to act to show that it's serious and hope that these forces sort of kick in down the line and prevent that recession from necessarily happening.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Monday, May 16th. Our top stories today. China's economy is paying the price for the government's COVID-0 policy. Two key gauges of economic activity fell to the worst levels since the start of the pandemic. Goldman Sachs cuts its forecasts for U.S. economic growth this year and next. Former Goldman CEO Lloyd Blankfein says the U.S. should prepare for a recession. And NATO members rally around Finland and Sweden after they announced plans to join the alliance. Turkey's raising concerns, but NATO Secretary General says that won't delay the process. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, it seems that the data coming out of China overnight, negative. We'd expected a negative story, but more negative than expected. That's shaken sentiment a little.
Yeah, that data coming in much weaker than economists expected. Retail sales in China fell 11%, a little more than 11%, so a much larger decline. As you said, Anna, both industrial output and retail sales were at their worst level since the pandemic began. So that definitely created a drag on Chinese equities overnight. The CSI 300 was down about 0.8%, though overall the MSCI Asia Pacific Index still able to post a gain of a little more than 0.1%. You had some outperformance from markets like Japan and Taiwan. But of course, in the foreign exchange market, you are definitely seeing the concern around Chinese growth showing up in currencies. The Chinese yuan, the big underperformer in Asian FX today, weaker against the dollar by a little more than 0.1%, trading right around that 680, 681 level. And then I have Chicago wheat futures on my Asia board today, which is a little unusual, but the reason why is this is an India story. India moving over the weekend to halt exports of wheat to stabilize its own food security. And the interesting thing, Matt, is that India isn't even that large of an exporter of wheat, but it really goes to show you with a more than 5% price move on wheat futures this morning how critical any aspect of supply is in commodities markets as the war in Ukraine has absolutely roiled them.
For sure, very tight supply here. This is one of the things I think that is causing futures to dip, or has caused futures to dip. We've seen them all over the place. They've been up 0.5%, they've been down 1%, and now they're off only 0.1%. So futures a little bit up and down this morning. U.S. 10-year yield coming a little higher as investors let go of some of that debt, but not back up to the 3% levels that we saw last week. NYMEX crude right now is little change, but it's at $110 a barrel. So it's at the same level as Brent right now, which I think is really interesting. There's almost no spread there, or even a negative spread. And then Bitcoin down another 4%, down below that crucial $30,000 level where a lot of people say retail buyers come in and move it back up to the price. We haven't seen that happen yet this morning. Anna, what do you see in Europe?
Yeah, interesting to look at what we see there in Bitcoin, Matt, because here in Europe, we started out in very negative territory, actually, as US futures looked negative at that time of day a couple of hours ago, and European equity markets were weaker, down by 0.5%, 7/8% on some of these major markets. We turned some of that around, but some of the negative sentiment around crypto was being cited as one of the reasons. Also, that negativity from the Chinese data also weighing on risk appetite for European stocks, but not so much now. Now we see some moves higher, flat really in Germany and in France, but moves higher on the London market. The sector picture looks a little bit confused today. So we're buying energy stocks, we're buying basic resources, buying energy even though the oil price is still a little weaker, even if it's off its earlier lows. But at the same time, we're buying healthcare and we're buying telecoms. We're buying some of those more defensive names. So quite an interesting picture on the sectors. The euro's interesting as well, making a bit of a rebound this morning, up by 0.2%. We've had governing council members of the ECB perhaps attempting to talk up the currency a little bit, saying that it does cause problems for the eurozone if the currency gets too weak. That's, of course, to do with imported inflation. Ryanair here, the share price of this discount airline down by 2.6%. Their outlook for the rest of the year a little bit lackluster, perhaps, compared to expectations. And so, as a result, that stock goes weaker. Valneva is a vaccine manufacturer over in France. They had a deal with the European Commission, that an advanced purchase agreement that the European Commission has flagged they don't intend to extend. It was due to be reviewed at the end of April, and it won't be extended, is the latest communication from Valneva. And so that stock moves considerably weaker. Kailey?
All right, Anna. Well, clearly there's already a lot of action on this Monday morning, but there is still much more ahead this week, beginning with U.S. President Joe Biden, who will host the Greek Prime Minister at the White House today. We'll also get some U.S. economic data tomorrow in the form of retail sales. G7 finance ministers and central bank governors will be meeting in Bonn, Germany from Wednesday to Friday. Plus, President Biden is set to visit South Korea and Japan for a 4-day trip. That is set to kick off on Friday at the end of the week. Plus, finally, Australia will be heading to the polls to elect its leader for the next 3 years. That's coming up this weekend, Anna.
OK, we've mentioned the Chinese data, so let's get to that. China's economy is paying the price for the government's COVID-0 policy. Industrial output and consumer spending have fallen to the worst levels since the pandemic began, and analysts are warning of no quick recovery. Bloomberg's Tom McKenzie joins us now to break down the data. Tom, the key takeaways then from this data set.
So Kailey touched on a couple of them, but it's worth reiterating retail sales, because of course the consumer in China was so key to driving the growth that we saw last year, I was going to say yesterday, in 2021. That has totally fallen away. They have not got back to pre-pandemic levels. So you're looking at a drop of more than 11% for the consumer, for the retail space, and then factory output falling as well. Crucially, for the Chinese Communist Party, obsessed with stability as they are, the unemployment rate going above 6%, and for youth unemployment hitting a record. So where does this leave the economy going forward? Many analysts now suggesting you could see a contraction in the second quarter. That makes the GDP target they've set themselves, policymakers, 5.5% for the end of the year, very challenging indeed. We know, of course, that there have been announcements around policy stimulus. The rhetoric is good, the reality on the ground not so good. How it filters through into cities and parts of the economy that are largely shut down or heavily restricted is a key question. We've seen some cuts to mortgage rates, maybe that's going to help around the edges. So the key for the economists out there is watching the COVID-0 policies, and the mayor and the officials in Shanghai saying they hope to get back to some level of normality by mid to late June.
Yeah, and keeping an eye on the stimulus. I mean, those mortgage rate cuts I thought were not big, but still very interesting. Tom McKenzie, thanks very much for that, giving us the full picture on China. Now, Goldman Sachs, the senior chairman Lloyd Blankfein is urging companies and consumers to prepare for a U.S. recession. He spoke on CBS's Face the Nation yesterday.
Do you think we're headed towards recession?
We're certainly heading. It's certainly a very, very high risk factor, and there's a path. It's a narrow path. But I think the Fed has very powerful tools. It's hard to finely tune them, and it's hard to see the effects of them quickly enough to alter it. But I think they are. I think they're responding well. I think it's definitely a risk. If I were running a big company, I would be very prepared for it. If I was a consumer, I'd be prepared for it. But it's not baked in the cake.
Let's get more now with Danny Berger out of London. We had, Danny, a ton of news out of Goldman Sachs and also a number of different institutions cutting forecasts for growth.
Yeah, the growth concerns really overtaking perhaps even inflation is the main worry of this market. You saw it last week with what risk assets are doing. You saw what Tom was describing, China data. You had U.S. consumer sentiment, the latest UMich survey coming in at a 2011 low. So the same day that we get Blankfein there talking about the risk of recession, that if you were a company, you should be preparing for it. You also had Goldman's U.S. economic team headed by Jan Hatzius also downgrading their look for the U.S. GDP. So 2.4% is where they see it in 2022. It was 2.6. Now they see 1.6% next year. That's down from 2.2%. They call this a necessary growth slowdown in order to bring wage growth in check and also bring inflation down to the Fed's target. They say unemployment, yes, that will go up, but not a sharp spike. So yes, lower GDP, higher unemployment, but they're not going all out recession. Now, it isn't just a U.S. problem, as you alluded to, Matt. Arguably, and many people believe this, that Europe is likely to fare worse off. Now, the EU has downgraded their financial forecast in a recent draft that was obtained by Bloomberg. Now, to be fair, this is a draft, so it could change. However, they are significantly downgrading their growth estimates, and at the same time, they think inflation will double. Will be the first report since Russia's invasion in Ukraine. Really just emphasizes that for Europe, the recovery post-COVID is going to be a lot sharper than many expected.
All right, Bloomberg's Danny Berger with a great breakdown. Thank you so much. Now, we were talking about Goldman Sachs, and on that subject, we should also mention that Goldman is allowing senior staff to take an unlimited number of vacation days. That's according to a company memo seen by Bloomberg. Junior employees will still have limits on vacation, but they will be given at least 2 extra days off each year. Now let's turn to geopolitics. It's another dramatic change in Europe's security structure triggered by Russia's invasion of Ukraine. NATO members rallied around Finland and Sweden after they announced plans to join the alliance. The one NATO member to voice concern was Turkey. U.S. Secretary of State Antony Blinken spoke on the matter yesterday.
There is very strong consensus for bringing Finland and Sweden into the alliance if they choose to formally apply. And as to the differences between Turkey, Finland, Sweden that have been talked about. There's an ongoing conversation, and the bottom line is this: when it comes to the membership process, I am very confident that we will reach consensus.
Anne-Marie Horder, Bloomberg Washington correspondent, joins us now from Abu Dhabi for more. Of course, she's in Abu Dhabi because she has been traveling with the secretary. And Anne-Marie, you were at that NATO foreign ministers meeting. What else can you tell us?
Well, it does seem, as Secretary Blinken said there, that, and he also said across the board, there's almost full consensus. Obviously, the one holdout at the moment is Turkey. But Jens Stoltenberg, the Secretary General, who also joined via video link to that conference, said that Turkey is not trying to block it. And Secretary Blinken said this is a process, and he did meet on the margins of this meeting with his Turkish counterpart. He didn't want to characterize or give details of that conversation, but they do seem, alongside him and the foreign minister of Germany, they do seem to think that there is a path for both these Nordic countries, Sweden and Finland, to quickly ascend into the alliance. Of course, potentially Turkey is using this moment as a point of leverage. They have come up with a few demands, but it does seem that there is potentially a pathway forward, and we do have some Swedish diplomats going to be heading over to Ankara to potentially work out some of those knots.
Anne-Marie, and you're in Abu Dhabi, and there is a reason for that. Take us through what you're there for and who you're with.
So I came here with Secretary Blinken, and he's now waiting to join other high-level American diplomats. And this is going to be led by Vice President Kamala Harris, and she's flying here alongside the Secretary of Defense, Lloyd Austin, CIA's Bill Burns, climate envoy John Kerry, and this is all in a condolence visit for the late ruler of United Arab Emirates, and to meet with Sheikh Mohammed bin Zayed, most notably known as MBZ. And this really comes, as a U.S. official described to me, a showing of strength of this relationship, at the same time that behind the scenes, they've really been trying to work out some of these differences. Over the course of the year, we have seen differences in not just the UAE, but also Saudi and the United States. One is a security difference. They really do not want Washington re-entering this potential nuclear agreement with Iran, especially when you had the Houthi rebels have drone strikes very close to where I am standing right now. And then on top of that, we've also seen the Americans and other consumers reach out to these Gulf countries, especially the UAE and Saudi, that have this spare capacity to try to pump more. And that, for the most part, has been snubbed. And you have a lot of Russian money at the moment coming into this country. The UAE is allowing that. They're almost welcoming it. And they haven't also denounced Russia. So you do have a very tricky relationship at the moment. But the U.S., with this incredibly extensive list of diplomats, is sending quite a strong message about where they see that partnership going.
Yeah, very interesting stuff. Anne-Marie, appreciate your globe-trotting reporting there. Bloomberg's Anne-Marie Horder from NATO to Abu Dhabi. Now, Germany, where I know she also was at the weekend, says it will stop importing Russian oil by the end of the year, even if there isn't an agreement on an EU-wide ban. Foreign ministers from the bloc are already meeting today to discuss the next round of sanctions. This after EU diplomats floated a delay in the oil ban after objections from Hungary. Maria Tadeo, Bloomberg's European correspondent, joins us now from Brussels. And this is interesting from Germany. I mean, it seems like they're trying to put up a bigger front after the ruling party lost another big, in fact, the biggest election in terms of state elections in Germany over the weekend.
Yes, Matt, there's the politics of it, but then there's also the catching up to reality. When you look at the numbers from Germany, you look at the imports of Russian oil into Germany, they've majorly declined ever since the war started. It was 35% of imports before the war. Now they're around 12%. So you can see here that for Germany, it's not that big a deal, especially if you compare it to gas. And what they're trying to do now is, of course, to inject some political momentum into this package. It's been 2 weeks that we've debated this situation, and still there's no deal, an EU27 deal. They now say, well, if Hungary and other countries in Eastern Europe are not prepared to do this, we're just going to do it by ourselves. But I would look at the numbers and say, overall, this is not the big deal for Germany. It really is gas. Now, the other thing, just to pick up on what Anne-Marie Mari was telling you before, I did speak with the Spanish foreign minister, who is, of course, the host for that big NATO summit that is scheduled to take place in June. That is, of course, my home country, but also the host nation for this. And he told me, I expect this to be historic. By that moment, in 2 months' time from now, potentially a month and a half from now, we will see 2 new members. He was absolutely convinced about this. He did say Sweden and Finland will join NATO, and this is such a watershed moment for European defense. This is the opposite of what Vladimir Putin was aiming with this invasion of Ukraine, though.
All right, Bloomberg's Maria Tadeo, thank you so much, as always. And don't forget, don't miss Maria's exclusive interview with Ukrainian Foreign Minister Dmytro Kuleba. That's coming up in the next hour from Brussels. Now let's get back to the market and take a look at some stocks moving in pre-market trading here in the U.S. A big outperformer to the upside today is Spirit Airlines. Remember, there's a bit of a tri-player saga going on in that first you had Frontier coming out with a $2.9 billion to buy Spirit. Then JetBlue came in and topped that with a $3.6 billion offer, equal to about $33 a share. Spirit rejected JetBlue's offer in favor of Frontier's. Now JetBlue coming in with a $30 per share tender offer for Spirit. So you are seeing a big lift to that stock, at more than 18% in pre-market trading at the moment. It's trading around $20 a share, so still about $10 south of that price. We'll have to see where that one goes. Another stock that is moving higher in a pretty substantial fashion this morning is Carvana, out after the bell on Friday with a new plan talking about raising free cash flow. Analysts seem pretty positive on it, so that stock is up about 9.6% this morning. But remember, it's down about 89% from its peak last year. And another group of stocks to pay attention to this morning is casino operators, specifically those that have operations in Macau, because of that China data out overnight, as we've been talking about multiple times already this hour. You are definitely seeing the likes of Las Vegas Sands and Wynn lower, and you also have Twitter lower on the day today. I really don't know what is happening with Elon Musk's offer for the company at the moment. A lot of confusion sown around that on Friday. Clearly, investors have some hesitation because it's trading at $39 a share in early hours this morning, about $15 below Elon Musk's offer price, Anna.
Yeah, ever further from the offer price then. Kailey, coming up on the programme, we'll talk to Alan Curtis, head of UK Equities at Lazard Asset Management. Alan Custis, sorry, we'll talk to him shortly. Is the UK a poster child for stagflation, or are slowdown in the economy concerns overblown? We'll talk about that. And also later on crypto, Diana Biggs joins us, DeFi Technologies Chief Strategy Officer, plus predicting Terra's implosion. Read today's big take story about the crypto hedge fund manager who saw it all coming. Just type NI Big Take into your Bloomberg terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. China's economy is paying the price for the government's COVID-0 policy. 2 key gauges of economic activity fell to the worst levels since the start of the pandemic. Industrial output unexpectedly fell 2.9% in April, while consumer spending shrank by 11.1%. Goldman Sachs cut its forecast for U.S. economic growth this year and next. The new outlook reflects the shakeout in financial markets and higher interest rates. Goldman sees the U.S. economy growing 2.4% this year and 1.6% in 2023. The former Goldman CEO Lloyd Blankfein says the U.S. should prepare for a recession. And it's another dramatic change in Europe's security structure triggered by Russia's invasion of Ukraine. NATO members rally around Finland and Sweden after they announced plans to join the NATO alliance. Turkey's raising concerns, but NATO's Secretary General says that won't delay the process. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. And Matt, European equity markets really retreated at the start of the trading day, sentiment taking a knock from the Chinese data. We seem to be working our way through that, though, and looking for future direction.
Yeah, it's interesting, I think, that you're coming back a little bit and that we're not seeing bigger drops here. You know, we have futures down about 1/3 of 1%, but earlier in the session, they were down almost 1 full percent. Now, there's so much bad news out there. As you say, the Chinese economic data not good. The ECB is expected to lower its growth forecast for the EU, and Goldman Sachs has lowered its growth forecast for the U.S. And, as you pointed out, a senior chairman said, get ready for a recession. Nonetheless, we don't see huge moves here, and investors are willing to let go of some 10-year debt. So I think that's really interesting. We're not back up to 3%, but we're starting to rise a little bit in terms of The yield. NYMEX crude right now down a little bit, but still over $110 a barrel, and Brent only at 111. So that spread has really come in. And then Bitcoin holding below a crucial $30,000 level. This is a retail level. Obviously, it's a round number, but whenever it drops, retail investors, at least historically, have said that's a chance to buy. And there are also big conspiracy theories about whales driving it down to 30 and back up to 50 and sort of playing a game with it. But Kailey, what else do you see in the pre-market movers?
Well, I'm really focused on the ripple effects of that weak Chinese data we got out overnight and that Anna was just mentioning, because of course a big part of that was consumer spending at its lowest level since the pandemic began. Retail sales dropping more than 11%. And that doesn't necessarily bode well for discretionary spending and maybe people wanting to gamble in Macau. You are definitely seeing that showing up in the stocks of casino operators that have big operations in Macau, the likes of Las Vegas Sands and Wynn Resorts, each down in the ballpark of about 3% this morning. You also have some pressure for the Chinese technology stocks listed here in the U.S. The ADRs of Alibaba and Baidu.com are each down about 1.25% in early hours, Anna.
Yeah, Kailey, here in Europe then, after early nervousness, we managed to claw our way back to flat, essentially, and we're pretty much there, down 0.1% on the stock 600. So waiting for further guidance. It's going to be a really busy week when it comes to data. The UK consumer, UK inflation picture will get clearer. We'll also get data on the US consumer, really crucial after that Michigan sentiment number. So all those big picture data points going to be front of mind for investors. The euro is up 0.1%. We have heard from some ECB officials just this morning, governing council members, trying to perhaps talk the currency up a little bit, saying, underscoring the difficulties that are created by a weaker euro for that economy, especially when they're trying to tackle inflation headwinds. Ryanair is down by 3%. This is a low-cost aviation business, of course, based in Ireland. The stock's down by more than 3%. Their argument is when things get tough for the consumer, then customers trade down, but investors maybe not quite so impressed by the forward guidance we got from this particular business than they had been expecting to be. Valneva is a French pharmaceutical business. That stock down by 20%. There had been an advance purchase agreement with the European Commission around COVID vaccines. Well, that looks as if it's not going to come to pass now, and as a result, the stock reprices, Kailey.
Yeah, in a big way. That is a massive move for one of those micro stories. But of course, at the macro level, it really seems that the focus has migrated from concerns around inflation to concerns around growth. That is evident in what we saw out of China overnight, in the U.S. Growth forecast cut from Goldman Sachs, Matt mentioned, as well as the downgrades to Europe's growth forecast as well. And in the UK, you have a Bank of England warning about a deteriorating outlook at the same time that it is willing to hike into weakness in order to stem inflation. Alan Custis, Lazard Asset Management's head of UK equities, is joining us now for more. Alan, how does that shift your view on that market in particular?
Yeah, good morning. I don't think it shifts us in particular. I think the Bank of England has been behind the curve in terms of catching up with the impact of inflation. But I think here in the UK, it feels like inflation is starting to peak. We think there's clearly going to be some more increases from the MPC, but we think perhaps the sort of 2.5%, which is what commentators are suggesting that interest rates get to in the UK, may be a little bit too much. And I think that as we move into 2023, clearly we'll have a base effect on inflation. And I think some of the heat may start to come out of that debate.
Alan, good to speak to you. Good to see you in studio here. Is that what you're seeing then in the UK, that we're peaking on inflation? Because the Bank of England and maybe some other commentators also suggesting that maybe inflation goes up again or doesn't really dip much during the summer and goes up again in the autumn, in the fall, because of the way that prices for energy markets in particular are controlled here in the UK. So is there a danger that we stick at really high levels of inflation here in the UK?
Yeah, I think there is that danger, but I think there are exogenous factors that are driving it at the moment. We talk about the energy price, we talk about wheat prices, general soft commodity prices. Clearly there's an exit route there which could happen over the course of the next 12 months. I think as we roll into 2023, then the sort of 8, 9, 10% inflation numbers that we're currently looking at, yes, they could go up a little bit in the short term, but I think as we roll forward to 2023, clearly the numbers are going to be a lot lower, which is then going to give a little bit of sort of wriggle room, I guess, to the MPC in terms of where ultimately interest rates will get to.
Do you find really constructive reasons to be excited about UK stocks at the moment, or is it all about exposure to energy and structural, the structure of the market, rather than excitement around the underlying assets, perhaps, and also the weakness in sterling maybe is good for some of those big businesses?
Sure. No, I think that's an argument that a lot of people have talked about. If you think about energy, mining, banks, 22% of the index. So you've got another 80% of the index that actually in a lot of places has held up quite well. I mean, I think about last week, you had Compass Group, for instance, guided upwards.
Global catering
business. Yes, guided upwards. There are a number of instances of companies like WPP that guided upwards. We're generally seeing some actually very positive profit expectations from companies at the moment. But at the same time, they are clearly, very cognizant of what's going on in the wider economy. But at the moment, trading actually for some of these global businesses, we've always said, equities are great for hedging against inflation. They really are bringing some inflation to play in terms of the P&L.
Does it concern you? Boris Johnson's government wants to rework unilaterally the Northern Ireland Agreement once again. Does this lingering Brexit problem concern you for UK equities?
Yeah, no, absolutely, it does. I mean, having managed money since the referendum vote in 2016 and the impacts that had on investors' perception of UK equities, we were hopeful that we kind of put that issue to bed. And this clearly just reminds us that this is not the case. What I would say is that when we talk to companies about the issue, it's not first and foremost. Clearly, since then, we've had the pandemic, we've had the supply chain issues, we've had the Ukraine conflict. So there are a number of issues that are of a sort of higher priority. But when I talk to my clients, I always say to them, just to remind you, that the Brexit situation has not gone away, and this was what I was concerned about, that it could come and rear its head again in the absence of other news, I guess.
Has there been any change, Alan, in the way your clients are investing, your UK clients are investing outside of Great Britain?
I've not noticed a change. There still is a move towards global. I think that there may also be a move towards maybe more relative value rather than the very strong, growth-orientated or ESG-orientated flows that we clearly saw over the last few years. So I think that clients are sort of pondering a little bit whether relative value, whether ratings on some of these high-growth stocks still have some ways to fall, and whether relative value is a factor or a style that they should be embracing.
Alan, thanks very much. Thanks very much for joining us. Alan Custis of Lazard Asset Management. Coming up on the programme, we'll also talk crypto, and that's with Diana Biggs, DeFi Technologies Chief Strategy Officer. That conversation coming up next. This is Bloomberg.
Bloomberg Surveillance Early Edition, you're looking live at the principal room. Coming up later today, Ukrainian Foreign Minister Dmytro Kuleba. That's at 6 a.m. in New York, 11 a.m. in London.
The thing that we hear from investors is really not so much about timing. Most of the investors who are putting capital into crypto these days are doing so over longer term time horizons. So they're not necessarily going to be deterred by volatility. In fact, they know it comes with the market and comes with the territory.
That was Grayscale CEO and big-time Bitcoin holder Michael Sunshine speaking to us earlier. A sell-off in cryptocurrencies has accelerated, though, today. Bitcoin dropping back below $30,000 a piece. Weak Chinese economic data, dented appetite for riskier assets, and, of course, something like Bitcoin is highly correlated. Now, for a long time, Luna wasn't. It was like a hedge against the problems in the rest of crypto. But as it drops closer and closer to zero, the failure of the entire Terra USD stablecoin experiment has prompted concerns. Joining us to talk about that is Diana Biggs, Chief Strategy Officer of DeFi Technologies. Diana, thanks so much for coming in. The success of a stablecoin, especially one that isn't connected to fiat currency at all, is so important to the future of DeFi. What does the failure of Terra mean for the entire universe?
Absolutely. So stablecoins are an integral part of DeFi and will continue to be incredibly important for this ecosystem. That being said, of course, not all of these projects are created equal. And so what this absolutely highlights is the need for effective regulatory engagement from the industry in order to understand the nuances between different types of projects and how they are set up, and to understand how these work under different market conditions as well.
But in these kind of market conditions, are we seeing a mass deleveraging? And I'm wondering if that spirals, if there is some kind of systemic risk at play here.
You know, it's incredibly difficult to predict what will happen in the coming weeks or months. What is quite unique to this ecosystem, of course, is the fact that it does happen in open public blockchains with the transparency, observing governance in real time, and having the ability to watch all of that happen. So far, I think, you know, rather than it being the instance that created this, rather what we're seeing is how it does play out during these market conditions that are affecting it now, rather than having been the cause of those.
Well, and these market conditions clearly haven't just affected stablecoins. It's really rippled across all digital assets, and as Matt said, Bitcoin back down below $30,000. How much lower can it go realistically if this is a winter type scenario?
No, absolutely. As we see in all sort of down markets, there will be winners, there will be losers. Certainly, we are very optimistic in the long term about the potential for these technologies, and therefore feel quite confident about how the strongest projects will fare, especially during this time where they're able to focus on building and really creating real utility and efficiencies in the markets, which we're seeing happen.
Diana, good morning. You talked there about stablecoins and the role that you think they will play, and they're not all the same. They're very different. Some of them, of course, are excuse me, asset-backed. Do you think it would be helpful to have more disclosure around the types of assets that are used to back these stablecoins and what exactly is held? Would that help to add confidence to the markets, do you think?
I think absolutely, absolutely. With that type of reassurance, it will be able to have the security that investors will then be able to hold out from fears and continue to have the trust in the markets that's necessary to really fulfill their promise of being a hedge against that volatility.
And you talked about regulation as being something that could help here by underscoring the differences between the different types of stable coins, for example, or helping people better understand the risks they're getting into. A lot of people in the crypto universe or DeFi maybe don't talk about regulation in that context, but is it possible to find that landing zone where regulation is really helpful in keeping people on top of what is going on in these markets?
Absolutely. Effective regulation will be incredibly critical for the industry, for Web3 overall to grow. Recently, we did co-lead an EU initiative where we were engaging with regulators in order to ensure the proper balance between the opportunities for growth and innovation that these technologies can provide, while ensuring, of course, consumer protection.
Diana, what do you think happened with Terra? I recently heard someone comparing one possible theory to George Soros breaking the Bank of England. Do you think there was a coordinated attack or some bad player that wanted to bring the whole thing down?
So that I don't have an answer to, but certainly, you know, this was a system that was tested during these market conditions. That could have been with intention or without. It's very difficult to say.
All right, I just think a pretty fascinating collapse there. Diana, thanks so much for joining us. Diana Biggs is the Chief Strategy Officer at DeFi Technologies. Be sure to tune in to Bloomberg Crypto Tuesdays at 1 p.m. New York time, 6 p.m. in London. Tomorrow we're going to hear from Joe Lubin, co-founder of Ethereum and founder of Consensus. This is Bloomberg.
This This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Well, let's head over to Wall Street. Hedge funds will disclose first quarter investments in 13F filings after the market closed today. The filings will show how hedge fund managers positioned themselves as the war in Ukraine, rising interest rates, and price pressures roiled markets. Sonali Basak, our Wall Street correspondent, joins us now for more on what to expect. So, Sonali, I think we're all going to be looking at the Tiger Cubs because we know they've had a really rough go of it so far this year. Yep. They held a lot of tech. The question is, do they still?
Yeah, that's the big question. The Tiger Cubs are certainly ones to watch. Chase Coleman at Tiger Global, D1 Capital, we want to watch Dan Sundime. Melvin Capital, after they've announced that they wanted to restructure and really kind of start over and really make investors whole again after a couple of years of very tough performance since the GameStop saga. So what's going to happen when you look at the names themselves? Remember, Kailey, when you look at the equity funds this year, by and large, most of them are in the red, according to Bloomberg's hedge fund index. You can look at that at HFGo. There's only a few types of funds that have really done well, and that includes certain types of merger arbs, activists, CTAs, trend followers, the likes of Cliff Asness if you followed value trades. But if you were long short in this market, it was really hard, and even shorting in many cases can be very difficult.
We'll always be keeping our eye on the Tiger Cubs. Not just because of their horrible performance this year, but because of their great performance before that.
Exactly. Yeah.
What are the other funds we should be watching?
Well, we like to watch family offices as well, the likes of Soros Capital, Stan Druckenmiller as well. So we do like to watch funds that are outside of the hedge fund world because they've gotten so big. We also like to see what the difference is between the hedge funds and the pension performance because they actually don't often go the same way. You have pensions also invested in hedge funds, so they like to diversify in that pocket away from hedge funds sometimes. So you see different bets, maybe overweight in technology sometimes when you come to the hedge funds at a little bit more defensive.
By the way, I mean, we don't have to watch Archegos anymore in terms of its performance.
Yeah.
But it just brings to mind the fact that you don't always know what big bets they're placing, right? I wonder if a lot of these other family offices maybe had gone down that road a little bit and have reversed course?
Yes, that's a great question.
Since the criminal trial started.
Listen, if you look at the broker-dealers' balance sheets, hedge fund leverage is still near record highs. I mean, it's pretty high still. So the question is, and those stories you're all seeing about that amount of deleveraging, you could still see from here is pretty significant. And the question then becomes, you look forward into the next quarter when you look at the banks and the prime brokerage activity, did there have enough dry powder on the side in the hedge fund industry to be able to play these markets through?
Sonali, good morning, it's Anna. I want to take us in a slightly different direction, but still very much sticking to the Wall Street beat, and that is this news around Goldman Sachs allowing senior staff to take unlimited vacation. And that's pretty interesting, and that's maybe similar to what we've seen in other sectors, in tech, for example. But what really interested me is the firm saying that it expects staff to take at least 15 days of vacation, of holiday a year. And it seems to me that that's really quite important. If what you're trying to do is actually bring about some kind of culture change, then you need to put in a minimum bar.
Yeah, it's really interesting because on one hand, you do see this happening for the senior staff. There is a great push on Wall Street. You're seeing Goldman Sachs, Morgan Stanley moving along the ways of providing different sets of benefits, more benefits to their employees. But a point that, we were just talking about in the commercial break is that unlimited vacation days can be tough for some folks because it comes to be that every day ends up being a negotiation with your managers to be able to get those days off. So you do see a divergence in thinking here from the different tech firms, banks on how to go about this policy. On one hand, it sends a signal to employees that they have a little more flexibility, especially if they're doing a good job.
The signal, you know what? The signal I hear is we're doing this for perception so that the public thinks we're nice, but you're going to take fewer vacation days when you get unlimited.
And potentially new hires also, knowing that it is an option when you have this very fierce war for talent in the banking industry and really in financial services at large. You've already raised what people are paying, salaries, bonuses, et cetera. So I guess now they're looking for more creative options as well to attract that talent.
And by the way, this year is not supposed to be as good as last year in many regards. Some desks might do very well, like certain trading desks at Goldman, which have completely blown it through the water. But again, if you're working that harder, you're going to take the time off. I think, that ends up being a conversation with your managers at the end of the day.
Shonali, thank you very much, Bloomberg Shonali Basak. I mean, Matt, what do you think? You've worked on both sides of the Atlantic. Is there a bit of a sort of transatlantic divide on this story? In that,
yes.
In Europe, there isn't so much an expectation that you don't take your holiday. In Europe,
No.
you get holiday allocated, and there's much more of an expectation that you take it.
I think in Europe it's considered civilized to take your vacations, honestly, and there is a real appreciation for the idea that you may do better at work if you have more of a life balance. In the U.S., that is not the case. They want butts in seats, and they want you working all the time. So that's just how it is. Especially, I mean, on Wall
Not so
Street.
much.
Am I wrong?
Yeah.
Am I wrong about that?
You're not
I'm not wrong. Okay, yeah.
He's not wrong. Okay, early edition surveillance. That's it for the early edition, sorry. Surveillance is ahead. They'll be keeping you up to date with what's going on in Ukraine. Talking to the Ukrainian Foreign Minister, and Mark Esper, former U.S. Defense Secretary, joins them as well. This is Bloomberg.